Okay, so this section, regulatory agencies and laws. This is not a section that I expect you to memorize everything in here. I'll be honest, I'm not the most educated on this section. I know these things exist and I know where to go if I need them. Same thing like with the laws and some of the other chapters. It's nice to know they exist and hopefully you never need them. But if you do need them, you could go look them up. And sure, if you plan on being some sort of financial planner or something along those lines, then yeah, you're going to want to be more knowledgeable in this area. Yes, these questions will come up on your vocab worksheet because that is pre-made by your book, but I don't anticipate putting these really on your test that I haven't made yet. So with that being said, so what regulatory agencies help consumers? So oversight is the supervision of activities to ensure that investors' rights are protected. So most of these agencies that we're going to go over provide oversight. So they make sure investors' rights are protected. So the first is the Federal Deposit Insurance Corporation, FDIC, which we have talked about plenty of times already. Again, established in 1933 to encourage consumer confidence in banks in wake of the 1929 crash, so right after the Great Depression. It ensures bank depositors accounts up to $250,000. So the government guarantees and backs that much money. They also monitor bank practices to ensure that lawful and ethical practices prevail. All federally chartered banks must participate in the FDIC program. They provide consumer resources. They have a website so you can look up for saving and investing resources. Next is the National Credit Union Administration, which is an independent federal agency that charters and supervises credit unions. Mommy. So they're also insured up to $250,000. Yes, baby. No, you had two. That's enough. This is the last one. Okay, last one. The Financial Industry Regulatory Authority, FINRA, they are a private nonprofit organization that regulates firms selling securities in the United States. It's comprised of bankers. They are firms that break the rules or charge high fines. And so they do this to kind of discourage illegal and unethical practices. They also test and license stockbrokers. The Pension Benefit Guaranty Corporation, yes, that's how that's spelled, is a federal corporation whose primary purpose is to protect the retirement income of workers with defined benefit pension plans. So it's a federal company. They are not funded through tax dollars. They're funded through insurance companies that offer pension plans. So if a pension plan fails for some reason, then the PBGC will pay some of it, not necessarily all of it. But if you're owed a benefit through some sort of pension, then it would be covered. You can go to their website to find out if your pension plan is covered, how a pension plan can end, the benefits that are provided, and things like that. But again, not everyone will have a pension. The Commodity Futures Trading Commission, CFTC, is a government agency that regulates futures and options markets in the United States, seeking to protect investors. So remember that futures contract is a contract that you agree to in the future. On this day, it could be a year or two down the road, I am going to buy this much of this at this price. An option is the same idea. Within a year, I have the option to buy this much wheat at this price, things like that. The Office of the Comptroller of the Currency, the OCC, is a government agency that charters, regulates, and supervises all national banks. So they want to make sure that they operate safely and provide fair and equal access to all financial services, that customers are treated fairly, and that they follow, all these banks follow laws and regulations. Next is the Security and Exchange Commission, the SEC. We talked about them earlier in this chapter a little bit. So they are the primary overseer and regulator of the U.S. securities market. They oversee the securities exchanges, brokers, dealers, investments, advisors, and mutual funds. They work with other agencies. So they don't work alone. I mean, they try to work together and collaborate with other agencies to maintain fair and orderly markets and provide business growth. Their goal is to protect investors, you, if you're investing. They enforce security laws. So the typical violations include insider trading, which you may or may not have heard of. Martha Stewart, who got in a lot of trouble for that a handful of years ago. And another common law broken is accounting fraud, which Enron was a big scandal a little while back. They have a movie on that one. I forget what it's called, but maybe you've seen it. And then the Department of Treasury. They are the federal agency responsible for the economic security of the U.S. So you've probably heard of the Department of Treasury, possibly. So they produce all money for the U.S., the currency, the paper dollars and coins. They pay the bills for the U.S. They supervise the national banks. They manage our federal finances and our national debt, which you should know we have a lot of. If you've taken econ, you've probably learned about that. They enforce federal finance and tax laws, and they prosecute tax evaders, counterfeits, and forgers. Their website also has information about saving and investing. And then the IRS is probably another one that you have heard of. The Internal Revenue Service. They are a bureau of the U.S. Department of Treasury, and their goal is to collect tax revenue. So their role is to help taxpayers understand and meet their tax responsibilities. And if you owe, they're the ones that come after you to get your money. And lastly, for the agencies that help consumers is the Federal Reserve System, aka the Fed, which is the central bank of the U.S. They are responsible for setting monetary policy, providing financial service to pretty much everyone, the U.S. government, financial institutions, and the public. They supervise and regulate the banking system, and they keep the country's financial systems and markets stable. We're almost done. And then the last little bit here, financial reform laws. So laws typically in these financial reforms typically come into place because for some reason they've needed to be created. So the Sarbanes-Oxley is a law that set new and stronger standards for public companies and accounting firms regarding the reporting of financial results of operations. It was created in response to financial scandals at large companies, often fraud or misconduct, that resulted in losses for investors. So they required improved financial reporting, auditing, and accounting services for public companies. And lastly, our last slide here, the Dodd-Frank Wall Street Reform, also known as just the Wall Street Reform Act, is a law that seeks to decrease risks in the U.S. financial system and enhance investor and consumer protections throughout the system. So this was passed in 2010, so this one's not that old. As a response to the financial crisis that happened a couple years before that. So back in like 2007 to 2009, we were kind of in a recession there. A lot of people lost their houses. Things weren't going well. So the Wall Street Reform, the Consumer Financial Protection Bureau was established. Credit scores. So consumers now get one free credit report a year from each of the 3 credit bureaus. So we've talked about that before, how there are 3 credit bureaus. So you have 3 different credit reports out there, and they all might say different things. It doesn't make sense in some cases, but sometimes they say different things. So you are entitled to get one free credit report from each of them a year. They established caps on interchange fees. So kind of when you use your debit card, that's what that is. So if you go to take money out at a different bank, or just the fees, you know, sometimes if you use your debit card at certain gas stations, it says like there's a 35-cent fee for this. So they set caps on those. Liar loans are prohibited. That means banks must verify and document salary income before making a mortgage loan. That didn't happen before. So before, when people would buy a house, they would just say, this is how much money I make, and the banks often believe them. That's not the case anymore. You have to show proof of income to verify how much you actually make before you can get a new mortgage loan. Because a lot of people were losing their houses because they couldn't afford it. The Wall Street Reform also includes credit rating monitoring. The Office of Credit Ratings was established to make sure credit rating agencies like Moody's and S&P provide meaningful ratings. So they were criticized before for misleading investors and helping create the financial crisis by overrating the value of investments. So saying something was worth more than it was. So now they have to have more meaningful ratings. They also, there's a credit rating monitoring, which is the Office of Credit. Oh, that's one I just talked about. I'm sorry. The oversight power. You're okay, baby. We're almost done. And increased insurance supervision. So the increased insurance supervision is ensures that affordable non-health insurance is available to minorities and other underserved communities. So other insurances like life insurance, car insurance, etc. So these last two, the new oversight power and the increased insurance supervision, basically they take a look at if there were failure, what would happen. So with the new oversight power, they look at the large financial firms that if they were to collapse would have a large economic impact, which wouldn't be good. So they kind of try to make sure that those are running more smoothly. And that is our last slide.